What are working capital needs? This section will go through the definitions of working capital and its needs. So we'll start with the disparity of sales. So this section, as I was telling, deals with planning of working capital and its requirements. Three things are mentioned in this section, namely needs of working capital, which is mainly what we will discuss. Working capital needs. To maximize shareholder wealth, the firm has to generate sufficient wealth. The extent of profit earned depends upon the magnitude of sales experienced by the firm. A successful sales program gets the business a momentum for earning profits. However, sales do not immediately convert into cash. Hence, there is a need for working capital. So basically, sales does not mean the firm earns cash. There is a gap between sales when it happens and the time in which cash is realized. So that gap, since that gap exists, there is always a need for working capital. So now why? Sales of products may be sales on credit where cash is not realized at the time the sales is made effective. Hence, working capital is needed by the firm. In other words, sufficient working capital is required to sustain sales activity, and this cycle of operation is called operating cycle or cash cycle. So that is what is operating life cycle or cash cycle. It is at the heart of the working capital calculations. In short, there is a continuous flow of cash from suppliers in the form of inventory that is made. Suppliers sell raw materials. Raw materials are used in the factory to manufacture goods. And these goods, along with raw materials and work in progress or unfinished goods, make the inventory. Hence, the cycle is defined from cash to suppliers to inventories to accounts receivable, where a credit sales is made effective and customer when buys it, and to cash when the cash is realized on sales. Hence, the continuous flow from cash to suppliers to inventories to receivables and back into cash is the operating life cycle or cash cycle. There are also specific computations that happen within a cash cycle, namely cash to inventory, inventory to receivables, and receivables to cash. So actually speaking, cash cycle has three stages. Stage one is cash to inventory. Stage two is inventory to receivables, and stage three is receivables to cash. So in stage one, cash is used to purchase raw materials from the supplier, and conversion happens of raw materials in the factory to work in progress. That happens in stage one. And it also would be converted to finished goods, raw materials, work in progress, etc., which basically makes up the inventory. In the case of trading organization, most of the stages of manufacturing is simply not there. In stage two, this inventory is transferred to stock at the end of the manufacturing and is made into accounts receivable in credit sales to customers. Firms who do not sell on credit does not have this stage. In stage three, the account receivables are collected and this completes the operating cycle. Thus, the firm moves the cash to inventory, inventory to receivables, and receivables back into cash. Thank you.